When you look at central bank policy, there's a lot on the Fed, but also there's the ECB. Can these central bankers do anything, or are they just waiting for the latest economic round of data to see where they are?
Well, I think they're waiting for the latest economic round of data, but they've also become risk managers with a mandate for global financial stability. And that's what the lesson was from last December. When you have growth this low, the volatility matters more. And I think the central banks understand that now. So we're not expecting a big change out of the Fed. We think they'll keep the patient in. I still think the market is pricing in a rate cut, which I still think is unlikely.
OK, what would need to happen for the Fed to cut rates?
Well, the growth numbers are looking better in the U.S. So I think you would have to see slower growth than what we have seen so far. And we think that both in the U.S. and China, you're going to have some better growth numbers out in this next quarter.
Joyce, when you look at the GDP figures, they looked good, and then actually you kind of lifted the bonnet and you were like, oh, actually, this is not as strong as we were expecting it to be.
Well, it's a mixed bag, certainly, around the globe. And in Europe, there have been disappointments. But it's certainly taking away some of the risk of, oh, it's a recession later this year. And that's really what the market had been focused on at the end of last year, at the very beginning of this year. And I think those fears are off the table for right now.
Joyce, so, as head of research, I think there's lots to talk here about the greater platform of JPMorgan. And one of the great things about JPMorgan, John Norman and the rest, is huge quantitative abilities. What's the tail risk right now? And what is the liquidity map that you see right now into Wednesday's meeting?
Well, one thing that we take a very close look at is the market positioning. And what we're seeing is that the market positioning isn't nearly as extreme as it had been at the end of the year. So volatility is low, but the positioning had been, very, very high going into this. And then you had very low liquidity on a seasonal basis back in December.
Where is that liquidity now? Where is that liquidity right now? I think there's some confusion of the JPMorgan view on that.
Well, I think for the liquidity right now, it's not at the extreme positioning we had seen at the end of last year, but the liquidity across the board has come off, a lot over the last few years, and December as well was a real test of that. So I don't know if we've seen such a big shift in the liquidity conditions as much as that the positioning itself is much lower.
One of the hallmarks of JPMorgan research, and I think of the wonderful Michael Ferroli, is a call for years of a lower terminal rate. Francine mentions the GDP report, 3.2%. It comes in a little light looking at domestic final sales. Can you refresh what is the terminal rate of the U.S. economy right now? The terminal GDP growth, rather.
Well, we are looking at growth right now running at about trend in the United States, and I think that the expectations had been that you could see a recession as early as 2020, and I think that what you've done with the Fed guidance is really push out some of those risks. So you're really looking at something that's post 2020 at this point in time. Everyone is waiting on the review that comes up in June, but what we're seeing right now is that there has been more of this debate, as Ferroli and others in our team have pointed out. But what we're seeing right now is that there's more time now before we have to worry about some of the tail risks that could come about.